So I think the narrative of the U.S. dollar, reserve currency going away, or the U.S. dollar going away as a reserve currency, I think it's just, it's sensationalist noise. Um,
You can
there,
swear on
there,
here, Dave.
yeah, yeah, it's bullshit. I mean, there's one reason, and we can talk about all these other crazy things, but the reality is the U.S. is the only market large enough to absorb all of these flows. There's just no other market. These are Europe collectively had, I believe, roughly the same GDP as the U.S. did coming out of the global financial crisis. Now it's a fraction of that. The U.S. economy is orders of magnitude larger than Europe. We have the strongest consumer base on the planet. I mean, there's one thing this country can do is spend. We are the consumer of last resort. We will pull in capital. We have the markets, the market depth, and forget the rule of law arguments. We just have the size to accommodate these flows. So I think the U.S. And this thing took decades to build. And even if nationalist policies chip away at that, I think it would take. I think to really in our lifetime to get the U.S. to not be the reserve currency, we would basically have to lose kinetic war to China. There's just no other way. It would take a severe body blow to the U.S. from China, where they basically win, they rewrite the rules of the global order, and we take a backseat. But other than that, there might be some degradation, there might be some whatever. But this is a not in my lifetime problem, so I'm not going to worry about it. In terms of what's the trade, so interesting. I was pretty going into the sell off. I was like, my thesis was a couple of things. The outperformance that we saw from rest of the world stocks at the end of in the beginning of 25, a lot of that was just making up for the prior 6 months. Europe was actually, or the rest of the world was actually down roughly. I have to go back to my spreadsheets and the graphs, but roughly September or spring through the fall, the rest of the world was down. So part of the initial ramp we saw in January and February was kind of just catch up. So I kind of saw it as, this is anomalous. And that's what gave me confidence to put the short on. Now, obviously, I'm starting to re-question that. Right now, the anomaly of the U.S. underperforming has gone on for longer than it typically does. So I use a 100-day rolling look-back window over the past decade, and typically the U.S. outperforms the rest of the world by anywhere from high 2% to high 3% on a rolling 100-day basis. That means every 100 days that goes by, the U.S. is typically done 3% better than the rest of the world. Right now, that is completely upside down. Right now, the U.S. is lagging. But what's crazy is that it's not just lagging, and that's going to happen, right? I mean, there'll be periods of under or outperformance. The thing is, the U.S. is lagging Europe by 3 standard deviations. I mean, that is just, it's not just 3 standard deviations as a one-off. It's persisted. You've had some pockets, but it's persisted, and that's making me, wonder: do we have a regime change? Is this kind of just cyclical flows, or do we have fundamental realignment of the economics between the two countries? And a lot of that's going to go back to the tariffs. How durable are these tariffs? How much of this is just, Trump being Trump and talking and people, positioning that and arbing that? Or how much of this is going to be durable and etched into stone that really realigns global flows around that? So right now, I think the jury is still out on that. I've given up my short rest of the world long USA trade has given up about half of its gains. So I'm holding on for now, but always, the way I approach it is, strong opinion is weakly held. I mean, that's you got to pivot, you got to face reality. So the trade is still profitable, but yeah, about half my gains are gone roughly. And I need to revisit that thesis.
Yeah, I'm
Go ahead.
curious. Yeah, just within that, I mean, it felt like, so the way I thought about it was, back in February, you had, okay, the narrative was the deficit in the US was going to go from 7 to try to get to 4, 3-ish or whatever. And on the other side of the trade was, you know, Germany taking off their debt brakes and starting to go big on fiscal. So if you have the opposite dynamic where countries like that are, I don't know what Europe is at specifically, but let's call it 3%, and they're trying to go to 5% deficit. So to me, that made sense at that time to be long rest of the world, short US. But now you're in this regime where, okay, well, US fiscal deficits are going from 7 to 8. And then the rest of the world, it seems like, regardless of what happens to tariffs, the fiscal shackles are coming off anyway. At least that's something you have to discount and assume. But it feels that way right now. So if you have those from going from 2 to 5, it feels like the trade is long everything, short bonds.
Yeah, I would think that's right. But I think you also need to get down to sectors, right? I mean, the European defense stocks. I forget the name of the ETF, EU something, the EU AB. That thing's up 66% this year, right? Now with this kind of where if the U.S. is pulling back on its security guarantees to Europe, and Germany's looking at rearming. Poland's obviously going to be frontline there. Finland as well. On the defense side, you got to look at these sectors. They're going to be in a secular bull market. It's not just I don't know if this is how sustainable it is on the consumer side or tech. Forget about it. I mean, Europe can't compete on the tech side with the U.S. Not yet, at least. But I think you have to be sector specific. I think the easy rest of the world trade. The easy money's been kind of done on that one, I think. Now you have to go into sectors.